Hi everyone, welcome to the Tradimo live webinar. Thank you for coming, and before we get going, I'm just checking if the sound is okay. Today we have our regular guest presenter, James Harte, trader and analyst from LittleFish FX, who will introduce you to the technique of multiple time frame analysis. You will learn what it is, what's its purpose, how to identify the dominant trend, how to find key levels, and how to apply momentum indicators in your trading. LittleFish FX is a trading education company, and their agenda is to democratize the financial market and make it accessible to everyone. They do so by providing daily analysis, proprietary indicators, trade alerts, and trading courses, and a lot more. Two of LittleFish FX's courses are available on Tradimo. It's the NFP course and Top Forex Trading Strategies. You'll find links to the courses in the description right underneath this video. The courses delve into more details about the concepts covered in this webinar. And if you'd like to learn more about how they trade at LittleFish FX, I encourage you to go over to learn.tradimo.com and check out these courses, or just click the links in the description below. Our current session is titled Multiple Time Frame Analysis. And now, without further ado, it is my pleasure to welcome our guest speaker and professional trader, James Harte, to the Tradimo webinar room. Hi, James.
Hi, Peter, and thanks a lot for that introduction, as always. And thanks a lot to everyone who has joined in today. Just to repeat, I'm James Harte from LittleFishFX.com. And we've been running a series of webinars for Tradimo recently, where basically we've been looking over some of the core elements of Forex trading, focusing predominantly on the technical side, but we've also been taking a look at some fundamental stuff too. And so the idea with these sessions in this series is that we'll build a sort of beginner's guide to Forex as we go along, and then start to dig a bit deeper and look at some of the more advanced stuff. So, as I say, we're covering a really wide range of topics in these sessions. So far, we've looked at support and resistance, trend lines, and channels. And in today's session, we're going to be looking at multiple time frame analysis. Now, multiple time frame analysis is a really important and fundamental method of technical analysis. So the idea is that the application really is strategy neutral, meaning that no matter how you trade, whether you're a pure price action trader or if you use indicators, whether you trade with the trend or counter trend, multi-time frame analysis can be applied to your trading and indeed should be a key part of your selective process. Considering the instrument or the market that you're trading on a broader scale, looking at different time frames, can have vast benefits for your trading. We're going to look at some of those today. And really, I think for a lot of new traders, one of the biggest problems that they face, and this is certainly true with a lot of the new traders that I talk with, is in gaining a solid level of consistency in both their trading and their analysis. So multi-time frame analysis obviously might not appear as interesting as playing with a new indicator or trying out a new strategy. But if you talk to some of the most successful traders out there and some of the most well-known traders out there, considering multiple time frames always plays a big part in their trading and analytical process. Okay, so kicking off first of all then, let's discuss the aims of multi-time frame analysis. So the first aim is to identify the dominant trend, okay, if there is one, with which you should be looking to trade to allow for bigger profits. The second one is to look to identify key locations, which can be areas that you're either going to look to trade or areas that you will target if you're in a trade, or simply areas to watch out for as you trade, okay? Now, as ever, if you have any questions during the session, please just write them in the chat function and I will stop as we go along to answer them. So we're going to look at how you can use multi-time frame analysis with just raw price action. And we'll also take a look at how you can use multi-time frame analysis with indicators combined. So when we're using multi-time frame analysis to get an idea of the dominant trend in the market, this is typically one of the most simple and effective ways of employing this strategy. Trends, where they can be identified, generally offer the best opportunities for profits. So regardless of what's driving the trend, whether it's central bank policy divergence, interest rate differentials, or driven simply by speculative action, it doesn't matter. Where we can identify a strong trend, then we should be looking to trade with the trend, because trend trading has proven time and time again to be the most profitable method of trading in the long term. So in terms of using multi-time frame analysis, we want to identify the trend on the higher time frames and then look to use the lower time frames to pick off entries. And once you get good at this and you can learn to really refine your entry points, you can start to identify some really powerful trading opportunities. So if our trading time frame is the H1 or the H4 charts, then we want to be looking at the daily and the weekly charts to get a sense of the bigger moves that are taking place to see if we can align with them. So, for example, if we know that price is heading down clearly on the weekly chart, then we are far more likely to catch a big move if we're playing to the short side rather than looking to buy. Okay, and this is the key thing with multi-time frame analysis. We want to look to use it to identify and align with major trends. So let's take a look at an example then and discuss this in more detail. So in this example, we have the Aussie dollar, and I think the period is over sort of spring, early summer last year. And this is a really good example. You can see that we've got a really nice bullish trend in play. Okay, so we put in our double bottom here. We've got our higher low, and then we started to put in some really nice typical bullish trend structure with higher highs and higher lows. Okay, so price is driving nicely higher after each retracement. So looking at this chart by itself, this 4-hour chart, the natural impulse would be to look for longs. Okay, we've identified that we have a really nice clear bullish trend structure. Price is breaking through highs, retracing, retesting those highs, and continuing to move higher. So looking at this chart alone, we would be considering longs. And indeed, I know a lot of people who are happily buying this exact move last year. However, if we take a look at this chart, which shows the Aussie dollar on a weekly scale, we get a very different picture. So this highlighted region is the 4-hour chart that we were just looking at. Okay, so now we can see that actually our so-called bullish trend, which was a bullish trend on the H4 chart, highlighted here in this section as part of the weekly time frame, you can see it's really just a minor correction to this long-term bearish trend. So looking at the H4 chart would suggest that our best opportunities would be to look for longs. And looking at this weekly chart, it's very clear that our best opportunities are in fact looking for shorts. And this, in simple, highlights the benefit of multi-time frame analysis. Because if I see a chart like this Aussie dollar chart on the weekly, what I'm typically looking for is a retest of last broken lows to look to play for a continuation of the trend. Okay, so for example, this last low here, so the last retracement and then breakdown, I'd be looking for price to retrace back into a retest of those broken lows. And for those of you who were in the support and resistance webinar, you'll know all about the reasons that underline this premise of thinking. So some very important points to consider here. Does a weekly bearish trend mean that you shouldn't trade a clear bullish structure on the H4 chart? Well, absolutely not. So going back to this H4 chart then, I can clearly see some really nice setups here that I would take. Okay, so we've got breakouts of highs, which is always a nice way to play with a trend. We've also got the retest of broken highs, which again is always a nice setup to look to take for in terms of playing a bullish trend. And now, if I was going to be taking these trades, I would be cognizant of the overall bearish trend. And this is the important point, okay? If you're going to be trading the lower time frames in a way which stands counter to the dominant trend on the higher time frames, then you need to adjust your thinking and you need to manage your risk accordingly. So if I'm trading with the trend, I might look to manage my trades in such a way that I allow for momentum to push my trade on. So instead of having a clear target on the trade, I might move my stops and be looking to catch momentum as the trend continues. However, if I'm trading counter trends, such as I would be here on the shorter time frames, then instead of just keeping my trades open and looking for them to run, because I'm very aware of the risk that at some point the higher time frame trend is going to continue and price is going to sell off, then instead I'll be playing for very clear targets. So I'll be looking typically for 1 to 200 pips, provided that the local technical landscape allows for that. So this is key. If we're looking to trade on the lower time frames, we need to be aware of what is happening on the higher time frames, not only with a view to identifying trading opportunities, but also with in mind of how we're going to manage our trades, how we're going to manage our risk in terms of the type of stops we place and also in terms of the type of targets we place. So if we go back to looking at our weekly chart, oh, bear with me for a second, I've skipped ahead. Oh, okay, this is confusing. Just give me 1 second. Just, I'm very sorry about this. Just give me 1 second. I think I'm missing a slide. Hey. Okay, so sorry about that. Looking at this weekly chart again then, these are the types of areas that I would be looking for to trade, okay? So we just talked about how we can use multi-time frame analysis to adjust our mindset and to adjust our approach to how we trade the lower time frames. But obviously, one of the key benefits of multi-time frame analysis is that we can use it to highlight important higher time frame areas. So in a bearish trend such as this, again, this is the weekly chart. So bearing in mind that these moves occur over weeks and months at a time and usually account for a very large number of pips per swing. So on a weekly chart such as this, as price is breaking down in a clear trend structure, then the types of areas that I would be looking for to get involved with the trend are typically retests of broken support and then retests of swing highs. So support such as this area here, supports here at swing lows, supports here at swing lows, and again, this would be a swing low. Then to the top side, the areas that I'd be looking at are swing highs, okay? So typically what we would see if price retraced into these levels is that we'd have a sort of double top formation as we had here. So this was only a very minor double top. Obviously, if price had extended all the way up to this higher resistance level, then we would have had a really nice classic double top formation. So identifying these levels is an incredibly important part of my process. And I do this every week and every day, sifting through the charts, looking at higher time frames and identifying key levels, because these are the areas where I know that price, if it is going to resume its trend, these are the areas that it's likely to happen. But these areas aren't only important in their capacity as potential trade locations, these areas also serve as targets. So if we're trading counter trend, or rather, if we've identified clear opportunities on the lower time frame in line with lower time frame trend structure, such as we saw with the Aussie dollar H4 chart a few minutes ago, then these areas actually serve as targets. So for example, if we're long anywhere here below this last broken support, then we know that this is likely to be an area where the higher time frame trend is going to kick in. And so if we're long on the lower time frames, then this needs to be the area that we're looking to bank and looking to take our trades off. Similarly, as we get close to these areas, it really isn't a good idea to be looking to initiate new long positions, okay? So whilst we might look to play initial counter trend moves as the move is in its early stages, as the move starts to approach these key areas, then we really don't want to be looking to get long, because we know that this is the area where the big sell orders, the longer term players, are likely to come back into the market and push the trend down. And this is where a lot of new traders come unstuck, because they get caught up just looking at one chart and they aren't aware of the broader context. So if we consider that Aussie dollar chart that we were looking at, as I said, the bullish trend structure on that chart really suggests that looking to play for longs is the best opportunity. However, considering the higher time frame shows that the market was in fact in a very clear and very well developed bearish trend. So to avoid getting caught out, we really need to be considering all of these time frames before we go ahead and click to execute a trade. Now, one of the big questions that you might have at this stage is that it's all well and good and it makes sense, but how do I identify the trend? Okay, and I know again this is something a lot of new traders struggle with, and you have a few choices really. So first of all, you could look to use a technical indicator to help you. You could look to use a moving average. Now, moving averages are a classic chart tool used by technical analysts and technical traders the world over, and they're a very deep and complex subject in themselves, so we'll actually take a look at them in isolation in another session. But for now, in terms of how we can use them to help us identify the trend, well, the beauty is they're very simple. Okay, you apply your moving average to the chart. Some classic ones are 50-day, 100-day, 200-day moving averages, and the premise is very simple. If price is above the trend line, above the moving average rather, the trend is classed as bullish. And if price is below the moving average, then the trend is classed as bearish. So looking at this example then, okay, so here is the sterling dollar on a daily chart. And you can see that I've got two moving averages on here. So the first, the yellow one, is a 50-day average. Now, you know that this gives us an idea of the trend over the last 2 to 3 months. We then have the red line. So this is a 200-day moving average, which is giving us a much longer term look at the market. This gives us an idea of the trend over the last 10 months or so. And as I say, these are very popular and a lot of analysts and traders rely on them as tools to give them an indication of the trend. So this is one way that you could go, okay? And as I say, the idea is that when price is below the moving average, then the market is classed as bearish, and when it's above the moving average, it's classed as bullish. Now, within that, there is a very specific way which you can look to use moving averages to identify trends, and that is to identify a crossover. So you can see here where the 50 moving average has crossed below the 200 moving average. So what we've had here is an indication that price over the last 50 days is now moving below the average price over the last 200 days. So this indicates that the trend in the near term has moved to the downside, okay? So looking to identify the crossover of a moving average is a very classic way, a very classic technical way of identifying a change in trend and indeed identifying trend direction. So we could just look to use one moving average as simply being a pivot. So for example, if we had just the 50 moving average on our chart, this yellow moving average, then we would say that whenever price is below that moving average, the trend is bearish. And whenever price is above that moving average, the trend is bullish. But when we're using two moving averages in conjunction, we're typically looking to identify crossovers. So where the yellow line crosses below the red, we get a bearish crossover. And then here, where the yellow line, the 50, crosses back above the 200-day moving average, this is a bullish crossover. Now, personally, I'm not that much of a fan of moving averages. I think that they can create a lot of traps. However, it's all about what works for you personally. So try it out and see how you find it. And if you find moving averages a good tool for guiding your directional bias, then that's great. Another option is to use an indicator such as the MACD, which can be really useful for giving trend direction and is actually sort of an advanced way of using moving averages. So MACD stands for the Moving Average Convergence Divergence Indicator, which sounds like some sort of eccentric 1980s invention. Is measuring the difference between a shorter term moving average and a longer term moving average. But then it also gives us a moving average of that difference. Now, again, using MACD is quite a full subject in itself. So once again, we'll look at that in another webinar in isolation. But essentially, the premise is that a positive MACD reading indicates a bullish trend and a negative MACD reading indicates a bearish trend. So the MACD in this example is the green line, okay? So you can see down here we have the green and the purple line. So the MACD is the green line. And whenever the green line is below this center line, the market is indicated as being bearish. And whenever the MACD is above the center line, the market is indicated at being bullish. So again, the beauty of this and of using the moving averages really is that it's very simple and it removes the subjectivity that a lot of new traders struggle with. So a lot of new traders that I talk to find themselves getting caught up on a weekly or daily basis, struggling to identify the trend. So using a technical indicator such as the MACD or moving averages provides a really easy go-to tool so that you can sift through countless charts and have a very easy method of identifying the trend. Now, it can be a good tool. However, the issue with both the MACD and moving averages is that if you're just using them blindly, so you're just taking the reading as your directional cue, then you will often get into trouble, okay? It depends on how you trade and what sort of setups you take, obviously. However, I certainly wouldn't advise just buying and selling a moving average price cross or a cross of the MACD, because although it tends to work well in trending periods, such as we see here, once the market starts to range and chop, you can get a lot of conflicting and false readings. So if you're just simply relying on a technical indicator for your cue, because the indicator is lagging, okay, because it's always referencing the past, it's never going to perfectly capture the current movements of price. And so for a lot of new traders, this can be a very frustrating learning curve, because relying on these indicators can often mean that you start to get caught out a lot once you enter these range-bound periods. However, if you can formulate a consistent process for how you use these tools as part of your analytical process, then they can be very useful. Now, the way that I actually like to determine a trend is very, very simple and very straightforward. I don't use either of these tools. I just pull up a naked price chart and I can see if price is in the top left-hand corner, moving down to the bottom right-hand corner, the trend is bearish. If I can see price in the bottom left-hand corner, traveling up to the top right-hand corner, then I know the trend is bullish, okay? And this might sound a bit flippant and it might sound a bit of a simple way of looking at things, but that really is the bottom line, okay? It is a very simplistic method. If price is moving from the top left to the bottom right, as we have here, then the market is in a bearish state, okay? So what I'm typically looking to do is identify the structure of price, looking at support and resistance, looking at swings to see if I can classify either a bearish or bullish trend. And if I can't see price moving clearly in one diagonal path rather, then I know that we're likely in a range-bound situation, and I either wait for a trend to develop or I look elsewhere. And this is another important part of using multi-time frame analysis, is that it really helps you to focus in on the charts that you should be looking at, okay? Because where you can identify good trending markets, and where you can identify these key levels, then these are the type of charts you get involved with. However, if you're pulling up a chart and you're struggling to identify trend structure and you're struggling to identify these key levels, then you simply know that you need to wait for price to resolve into a clear trend, or you simply look elsewhere. So in terms of how we identify trend structure, just using naked price action, if we take a look at our next example, okay, so here we have the same cable chart again, without the moving averages, without the MACDs. So if we look at the chart chronologically, so going back to the start, you can see that initially price is moving in typical bullish trend structure. We're making higher highs, higher lows, higher highs, higher lows, okay? So each time the market pushes higher, it's breaking out above the last high, and each time the market retraces lower, it isn't breaking down past the last low. So this is what we call textbook trend structure, okay? Now, once price turns from this apex here and breaks down beyond the last swing low, then this alerts us to the fact that the trend is potentially changing, okay? Just because we've broken the low doesn't mean the trend has changed. It could just be a particularly deep pullback, and this could occur for all number of reasons. It could be on news result, for example. However, one way that we can then look to clarify whether or not the trend has changed or whether or not the original trend is going to continue is looking to identify what happens when price makes its next swing high, its next up move, okay? So having retraced lower here and broken through the last swing low, you can see that price then retraces higher here. However, instead of trading higher and breaking out back above that initial high, we put in a lower high, okay? So at this point, not only have we broken down past the last swing low, and indeed you can see we actually broke down past some subsequent some previous swing lows, but we've actually put in a lower high. So at this point, we have confirmed a turn in the market, okay? Price has been making a series of higher highs and higher lows. We've then broken down below the last swing low and put in a lower high. So at this stage, we're then looking for price to break down and make a new low, to make a lower low, which you can see we do at this point. We then retrace and put in another lower high. So again, for those of you who are familiar with trading, this might seem like a very simple method. And again, for those of you who aren't new to trading, it might also seem simple. But I promise you, if you become really competent and confident in studying the market in this basic way, and you get confident with analyzing price swings and referencing structure, then you will have a much easier time in terms of determining a trend and in terms of determining opportunities than you will if you rely on indicators, okay? So looking to analyze the actual raw price structure is a much more reliable way of getting a sense of the trend. So if we continue with what we saw then, price continued to break down, making lower lows and lower highs. So we moved from our typical bullish trend structure to our typical bearish trend structure. And then at this point here, we got a reversal, okay? So you can see we broke out above the last swing high here. We then retraced lower, put in a swing, put in a higher low. We then broke out above the next swing high to put in another high, retrace lower and put in a higher low. So at this point here, I would be expecting that we were at the start of a new bullish trend, okay? So similarly to what we saw here when the market changed from bullish to bearish, we could expect reasonably that the same thing was occurring here. We've broken out of our typical bearish trend structure and we started to put in clear bullish trend structure. However, once we've broken out above this initial high, you can see that the market comes back down and retraces, but doesn't break that low. We then enter a range bound period, okay? So from making this high and making this low, you can see that the market spends several months just chopping sideways, neither breaking higher or lower. So whilst the market is contained in this sort of price action, we know that we have no trend, okay? So unless you operate a mean reversion strategy whereby you're looking to trade reversals back to the mean point, looking to trade range rotations, then you want to be looking elsewhere, okay? And so this is another key part of how you use multi-time frame analysis to adjust the way that you apply your strategies. Because once you can identify the market as moving in a clear trend structure on the higher time frames, you know that you want to be looking to play for momentum moves. However, once you identify the market as having entered a range bound period, then you know that you want to be looking to trade mean reversals and range rotations, and that there likely isn't going to be much momentum in the market in terms of breakouts. From that point, however, you can see that price breaks down through those lows, sells off, and then we get a resumption of our classic bearish trend structure with a series of lower lows and lower highs. So that is the process that I follow when I'm identifying trends, okay? I pull up my charts and very simply, I look to first of all establish in which direction is price moving, up or down, and then I look to really zero in on the structure of price itself to get an idea of where we are and where we're likely to go next. So this is a very important piece of the puzzle, and to use multi-time frame analysis effectively, you also have to be really efficient in how you're able to classify markets and in the way you're able to identify trading context. Okay, so for the final part of the multi-time frame analysis session then, I'm going to discuss with you how you can use technical indicators as part of your analysis. Now, we've already looked at using the MACD and using moving averages to identify trend direction. So if we're trying to establish trend on the higher time frames, we might use these tools to do so. However, once we have our trend established, we know that we always want to be on the lookout for key market locations which could be potential turning points, serving as either potential trade locations or targets, or merely levels to watch out for. So we can also use technical indicators to give us important information about the markets to consider whilst we're trading. So in the same way that we looked earlier at identifying higher time frame levels, these key higher time frame levels that we want to be aware of and that we want to look to use as opportunities for trading, then in the same way we can also use momentum indicators. And one of the most commonly used indicators, and it's an indicator which features in an awful lot of institutional technical analysis, is the stochastics indicator. Again, another indicator which we're going to explore in isolation in a later session. But for now, we're going to focus specifically on how this indicator can be useful to you in terms of multi-time frame analysis. So we've already said that we want to try as much as possible to trade in line with dominant trend, in whichever instrument we're trading. And the stochastics can give us great information on the health of that trend and alert us to potential key turning points in the same way that identifying key levels can. So the stochastics indicator measures the closing price of an instrument against its range over a given period and is essentially used to determine the strength of movement in price. So the momentum behind price, specifically then highlighting periods of potential exhaustion where price is considered either oversold or overbought and thus vulnerable to a reversal. Okay, so looking at this daily chart of the sterling dollar again, and you can see we have our stochastics indicator in the bottom panel of the screen here. So it's just set up with the default settings. And the idea simply is that once the stochastics indicator moves up into the upper threshold, it identifies momentum as being overbought. And when it moves down into the lower threshold, it identifies momentum as being oversold. And you can see that there were several instances during this period that the stochastics indicator moved into extreme levels. And look on the chart, I've highlighted the corresponding regions, and you can see the typical reaction that we saw from price, which was, of course, to yield a reversal. So if we think about the information that the stochastics indicator is giving us, it's incredibly important to consider, because as we looked at with the higher time frame levels, if we're trading on the lower time frame and we're approaching a key higher time frame level, we need to be aware that the market could turn. And similarly, if we're on a lower time frame and we're looking at the higher time frame stochastics and can see that they've moved into oversold or overbought territory, then again, we need to be aware that the market is vulnerable to a reversal. So for example, while on the lower time frame, we might see price as coming off this high, for example, and it being a good opportunity to get short. However, we might look to the daily stochastic and see at this region that price is actually extremely oversold. And then you can see that instead of continuing to break down lower, price actually reverses and takes off higher. So this is a really clear example of how we can use higher time frame stochastics to alert us to potential directional moves on the lower time frames. And if we actually zoom in and take a look at this area on the H4 charts, okay, so this is the high that we just came off, right? So if we go back just to make that clear, so we're looking at this move here, okay, we've broken out above this high, we put in a new high, and we've retraced. So if we take a look, we can see clearly the importance of referring to the higher time frames, and specifically in the context of using indicators such as stochastics. So we can see initially we have cable moving sharply to the top side here. We broke out above key resistance at this point. And so looking at this chart, we might be thinking that this is a great area to look to get long, okay, playing a breakout above these highs. However, looking to the higher time frame stochastic, then I've highlighted the regions where the higher time frame stochastic has moved into extreme territory. And you can see that shortly after we broke out above these highs, the higher time frame stochastic was flagging momentum as being overbought. And you can see that from that point, we got a reversal lower. Now, similarly, once we broke down from that high, you can see that we started to put in some nice trend structure. We put in a lower low, we put in a lower high, we broke down. And as we broke down below that next low, once again, we might be looking to get short, okay? So these are classic telltale signs of a technical setup that we might be looking to get involved with. So as price breaks down, we might be considering getting short. However, you can see highlighted here the region where the higher time frame stochastic had actually moved into oversold territory, okay? And so instead of price breaking down from that point, we actually bounce and take off to the top side. And then once again, another really great example here. And you can see that as price turned higher and broke out above this high, we might now be thinking to ourselves that finally price is going to take off, okay? If we look at what we actually had here, we had an initial low, an initial high, a higher low, and now a higher high. So we might be thinking that this is finally the point where this chart is going to break out to the top side. But once again, the higher time frame stochastics are flagging momentum in the market as being overbought, and it suggests that a potential reversal could occur. And you can see that we do in fact reverse lower from that point. And this also highlights another way which we can look to use our momentum indicators on multiple time frames, which is looking to identify synchronicity between the two, okay? Because you can see, as well as the higher time frames identifying, as well as the higher time frame stochastics rather, identifying momentum as being overbought, you can also see that the H4 stochastics are identifying momentum as being overbought. So we actually have a confluence of momentum readings here. And you can see that once price moves up into that territory, we stall out and start to reverse lower. So actually what we've got here is a double top pattern, okay? And for those of you who are familiar with chart patterns, you'll know that this is a classic bearish reversal pattern. And for those of you who aren't familiar with patterns, then once again, we'll take a look at them in another one of these sessions. But what we've actually got here is a classic double top structure with technical confluence by way of stochastics readings. So we've got the higher time frame stochastics registering overbought, and we've got the lower time frame stochastics confirming the move as overbought. So looking to get short once price breaks back down below that initial low is a really good way to look to play this move. Okay, so we've covered a lot in that session, and I hope as ever that you found that really useful and that you're excited about building multiple time frame analysis into your trading and analysis work if you don't already. As I say, I know that a lot of new traders struggle initially with multi-time frame analysis. It can be daunting enough to get to grips with just looking at one chart instead of having to consider a series of different time frames. However, I guarantee you that if you build multi-time frame analysis into your trading, and if you look to incorporate studying the moves that you're looking at on different time frames, you really will improve your ability to select good trades and to stay out of subpar trades. And it will also help you in identifying powerful opportunities to enter in line with the trend. Okay, so thanks a lot everyone for that, and look forward to our next session together. Cheers.
Thank you, James. I hope everyone enjoyed the webinar. So if you like the concepts introduced in this webinar, please head over to learn.tradimo.com and check out LittleFish FX's and top Forex trading strategies courses. When you take the top 4 Forex strategies course, you get a complimentary 1-month access to analysis and live trade alerts. LittleFish FX are also offering 20% discount for all Tradimo members on indicators, analysis, and signals. So if you'd like to take advantage of that, visit littlefishfx.com and use the coupon code LFXTradimo at the checkout. Thank you again for coming. For the next session, please watch our announcements, and we see you again in a few weeks' time. Thank you. Bye-bye.